Hey, Seth Bradley, founding partner of Raise Law. Today we're cutting through the noise. Syndication or fund? Which structure do you pick when raising capital? No fluff, just telling you what works. If you're raising private money, you've got these two main paths. Let's break them down and let's do it quickly. Number one, what is a syndication? A typical syndication, you raise money for one specific deal. An example, you find an apartment building or a retail shopping center, you raise investor capital, and you manage that specific one asset. You exit, you distribute, end of story. So what's good? Very clean story for your investors. You've got this specific deal, this specific asset. It's really simple to explain. The investor knows exactly what they're backing. What's the trade-off? Well, your risk is concentrated as the investor. If the asset tanks, it really matters. Also, typically longer hold periods or no exit opportunities, they're tied to that one outcome. Number two, what is a fund? A fund is a pool of capital you raise, and you might deploy that across multiple assets over time. You're saying, here's our strategy, here's our buy box, but we'll deploy the money into several deals or even a portfolio. What's good about that? Diversification, more scalable. You can attract investors who want exposure across many deals rather than betting on just one. So what's the downside? Well, you've got to build trust and credibility with your investors because investors are going to ask, what deals are you going to buy? And you don't know yet necessarily. The pitch is less concrete if you don't have a track record. Also, there's more legal and operational complexity. So how do you pick? Your track record. If this is your first raise and you have one killer deal in hand, syndication likely makes more sense. Now, if you've done several deals, a fund may be the next level. Next, look at your investor base. What are their expectations? Do your investors want to know this asset, or do they want exposure across many assets? Next, look at time and scale. If you want to scale, do a lot of deals, build a big business, a fund might win. If you just want to raise for one thing at a time, syndication wins. Next, look at structure and cost. Funds typically mean more setup, more compliance, more investor materials, and a little bit more time. Syndication, it's leaner, it's faster, it's quicker, it's simpler. Next, risk and reward. With a syndication, you're all in on one asset. With a fund, you spread that risk across multiple deals, but you might give up some upside or have a more complex story. Look, at the end of the day, both structures work, but only if they're set up correctly, legally sound, and aligned with your capital raising strategy. This is exactly what we do at Raise Law. We help sponsors, fund managers, and independent capital aggregators set up bulletproof syndications, funds, and fund-to-fund structures the right way the first time. If you're debating which structure is right for you for your next raise, don't guess, book a free legal consultation with me and my team. We'll walk you through the structure, compliance, documents, and the exact steps to raise capital without stepping on any landmines. Click the link below and grab your spot.